Welcome to John Author's Note, which today comes from Tokyo, where there is enormous excitement, especially among international investors, about Prime Minister Shinzo Abe's campaign to reflate the world's third largest economy. Now, I'm joined by Yasunari Ueno, the chief markets economist at Mizuho Securities, who is not one of the people very excited about so-called Abenomics. Now, Ueno-san, yes. Why? If I have this chart here, which shows the outperformance of Japanese equities relative to other developed markets since mid-November, when it became clear that Mr. Abe would win the election. Why are you skeptical?
I'm not suffering from amnesia. Abenomics is a kind of a revival of Japanese government's economic policies. We already saw a massive expenditure from fiscal side in 1990s. And as for quantitative easing by the central bank, we saw one example between 2001 and 2006. And as for the so-called growth strategy, every Japanese cabinet has made such a document, but without any strong initiatives.
So if Abenomics won't work, meantime there are risks, aren't there, in the unfolding of these policies. I have a chart here showing the yields in the government bond market, which have, contrary to the intention of Mr. Kuroda, which was to reduce the cost of borrowing all along the yield curve, we have increases here in the 2-year yield, the 5-year yield, and most dramatically in the 10-year yield. What's going on here?
Yes, there is a malfunction of Japan's bond market. The BOJ declared massive buying of JGBs, and the market sentiment is too much dependent on BOJ's operations and actions and some voices from BOJ officials. So the market is not in good shape, so very fragile, scant liquidity, high volatility, and that means weak power of buying of dips. So the Japanese bond yield is going to be a little higher. The priority there is first higher stocks, then weaker yen. The bottom is the level of long-term yields. So if the higher long-term yields destroy higher stock prices, then the BOJ or the government is going to extinguish the fire in the bond market. However, now the stock market is firm, so no big reaction to the higher long-term yields.
And do higher long-term bond yields mean that investors are positioning for inflation? Because I have another chart here showing Japan's long-term record, but Japan has a deflation problem, doesn't it?
Yes, so in March we saw minus 0.5% for core CPI year-on-year basis. And in April, it will be around 0.2 to 0.3. And in May, it will be around flat. And in June, we are going to see a 0.2 or 3 positive CPI core number. It will be a little shock for the JGB market. However, when we see energy market movement, I confidently forecast the positive change for CPI core. However, this is a kind of supply side shock, not pulled up by demand side, stronger internal demand. BOJ is targeting 2% within about 2 years. However, it is totally impossible in this economic reality. And if we see higher consumption prices indices, then we need higher pay rates. About 5 to 6% strong wage hike is needed. My forecast is that. However, this year we are going to see about 1.8 or 1.9%. So there's a huge gap between them.
So perhaps a sobering view for foreign investors then, a reminder that despite the intense international excitement over Abenomics, some of the fundamental reasons for investors' aversion to the world's second biggest equity market haven't necessarily gone away. For more on this and other stories, please go to ft.com/markets.